My name's DeBevoise. I'm the founder of a company called Machinima, which is a large video gaming brand on YouTube. We reach about 300 million people per month, generate about 3 billion views. During the time while I was CEO, which I'm no longer CEO, I'm the chairman, founder, I invested in a lot of companies in the space that you may have heard of: Tastemade and Style Hall, Me Too, Drama Fever, Zephyr, a bunch of the companies that are in the YouTube model. And so recently, I have a new CEO at Machinima, and I've started a seed fund. So we're investing in different categories, but video primarily, mobile messaging meets media, and virtual reality. And one thing I got to say is that I don't think there's been a better time ever for the Los Angeles community. You know, you see companies like Snapchat and Oculus and obviously Maker and all the companies that are here in LA on all three of those fronts, and obviously what Brian Lee's doing with e-commerce. So I think there's an incredibly vibrant opportunity for all of you that are starting new companies.
Go ahead, Everardo.
Hi, my name is Everardo Gomez. You can call me E, make it easier. I work for Silicon Valley Bank, and we're a bank that has banked technology companies for the last 30 years. We bank Machinima.
We bank everybody.
Yeah. So we're here for the startups, and I agree with Alan. There probably hasn't been a better time to be an entrepreneur than now. There's a lot of liquidity in the system. Capital markets are hot. We're lending money easily. It's a great time. And I don't think the entrepreneur has ever had as much say in dilution and things like that as now.
Alyse.
Hi, I'm Alyse Killeen. I'm on the investment team at March Capital Partners and Clearstone Venture Partners. March shares 3 investment team members with Clearstone, and March is a first-time fund focusing broadly on technology innovation, both enterprise and consumer, with a very strong affinity for LA startup teams.
My name is Oded Noy. I was the co-founder of TrueCar, and now I'm part of Amplify. But even more importantly, especially for a community like that, especially at the beginning of the year, I'm sitting here because all the things I did wrong, mostly. So arriving anywhere worthwhile requires getting lost. So when you think about building a business and you think about people on the panel here, it's not just about doing right, it's having the willingness to do things wrong too.
I'm Vishal Lugani. I'm at a venture capital firm here in town, as well as in New York, called Greycroft Partners. We manage about $600 million across 4 funds, and we're currently investing out of an early stage fund focused on Series A investments and a growth stage fund, sort of later, growth stage companies. And just excited to be here, and we're all about supporting the LA community.
Awesome. And as you guys know, I'm your moderator. My name's Espree Devora. I run WeAreLATech, which is a virtual tourist office for LA startups. We have a podcast focused on LA startups, number 2 in the country, a calendar of all the LA startups events, which you guys probably know, and a job board focused on LA tech. And I'm just really honored to be with you guys tonight to talk about what to expect for startups in 2015. So let's get into it. So what do you guys see coming up? Like, people are moving here from other states, moving to Los Angeles, thinking that they should start their startup here. People are now moving from San Francisco to LA to do their startup. Let's get into it. Like, what do you guys see that's coming? Who wants to kick it off?
Well, I mean, I think I'm very focused on the consumer kind of video, VR category. But clearly, Los Angeles has an incredible creative community, has an incredible infrastructure community, post-production companies, et cetera, schools that teach video and the like. The fact that Oculus is down here as well. And so I think that there's a real opportunity in that space. And I think we're seeing already, just last quarter, we saw Awesomeness TV do a new round with Hearst. We saw Style Hall be sold, Drama Fever sold just last year. Maker happened, Vice got a huge round, BuzzFeed raised a huge amount of money. So there's a lot of happening in this disruption, with the video category. And of course, VR with Oculus and Magic Leap. So we're starting to see a lot of opportunities there. So I think ultimately, there'll be tools companies, there'll be platform companies that are out there, but ultimately there'll be the programming brands. This is where it's really LA's time, where the companies like Vice and Netflix, even though they're not here, but Hulu, these kind of companies where they're actually branded, understand programming, understand content, the relationship between content and technology. And I think this is why it's kind of a great moment for LA.
I can take that. Let's make it a little more personal. So one of the things that people say about Los Angeles is, well, there's a lot of space between people and it's hard to create community and so on. What's interesting about what's happening now in LA is that there are enough companies that have actually succeeded here, which means that there's the first generation entrepreneurs that not only have the gray hair or no hair to prove it, but also the fact that they've gone through the steps that requires to succeed with a company. And one of the interesting things about this particular community, and it is a community, that unlike other cities, there's no sharp elbow mentality surrounding the startups that you're doing. And this is not, for many of you, it's not about coming up with this magical genius idea that becomes Zappos at some point. It's actually starting somewhere that you know where you're starting, collaborating with other people around you that are like-minded, and one thing leads to another, and before you know it, you're participating in some startup that's doing something magical. So again, it's the willingness to participate, and we have a unique community here, and I think we're the second or third largest market now in terms of that activity. So activity happens all around you, just jump in and do it.
I would agree with what was said before, and also I'd emphasize the fact that the resources exist in LA to build big companies, and so some of those have been referenced by the previous speakers. So indeed, LA has seen enough large exits where entrepreneurs have stayed and reinvested in the community. And what I mean by that is both reinvesting time and advisement and mentorship to younger teams, companies, and leaders, but then also reinvested the earnings of their success or the wealth that they've created back into startups here. And so that certainly has built a more robust infrastructure and community and network for folks to depend upon. And we also have incredible engineering talent here. And so the ability to recruit teams and retain folks is a strength of LA at this point rather than being the opposite. So we graduate the largest number of engineers, I think, in the country in terms of the city, and are able to offer them opportunities to innovate in a way that I think that we haven't for the maybe several decades ago we had, but LA has become more vibrant and we're able to retain the talent as a result.
Go ahead.
Yeah, and I mean, also just if you think about the industry mix in LA, so the biggest industry in LA is manufacturing, believe it or not. We have the busiest port in the country. Obviously, entertainment's huge here. Defense and aerospace is always had a legacy in LA, and then real estate, of course, is also just a really important industry. And so, as you see these industries that in the past haven't had as much attention start to get disrupted by tech, and you see that intersection with tech across all those industries, I mean, I think that makes LA an extremely exciting place to be. And it's also just a market that really lends itself to building consumer businesses. I mean, I personally think that if you want to build a consumer business, this is the market to do it in. There's so much creative talent. It's such a diverse city. I mean, you just see that driving around. And so, I think there's a lot of facets of this market that are just extremely exciting.
Wait, what do you think?
Yeah, I totally agree. We've grown a lot here because we want to support the entrepreneurs. And I think when Snapchat decided to stay and not sell, allegedly, right? I think that was huge for LA because there's a whole, they could have been in Stanford, they could have been anywhere they wanted, and they decided to keep that company here. I think that signaled to the rest of the community that there's a lot going on in LA.
Definitely. And something Alyse said about engineers, this is a big issue, that there aren't enough engineers for the demand. What can we do to fix this? And we do have excellent universities to learn from. So where's the disconnect? What's happening?
Well, I mean, I think part of the problem for a long time is we did graduate all those engineers, but they all went up north. And this is obviously an exaggeration, but for the most part, that's probably some truth to it. Now that they can see companies that are really big and scalable down here, I think it's an opportunity. In fact, Snapchat was the reverse, right? They actually came down here. So I think that's an interesting model. And the more successful companies will be here, obviously there'll be a bigger opportunity to keep engineers.
I think also engaging with folks while they're in school is important on the engineering side. So meaning, so creating an environment for them in school where it's not just academic, right? So, and we're seeing that happen now with Viterbi Startup Garage, or there's outreach programs happening in Pasadena for Caltech, as there were before, and that's kind of where Clearstone came from, actually, from Idea Lab, when Idea Lab was very well connected with Caltech. And so the infrastructure starts to exist where engineers see LA as a viable option for innovation rather than just continuation of in academia.
What do you guys think? How can we solve this engineer demand?
So I have a different perspective. With all due respect, probably wrong question. So I was fortunate enough to co-found the CTO Forum of Los Angeles about 12 or 13 years ago. There's actually probably more engineers active in Southern California than there are in the Bay Area. We don't have an engineering problem. In the Bay Area, there's a different dynamic where everybody goes to a coffee shop and you can find them and you can route them and move them from one place to another, but they have a different problem as a result of that. There is not a real lack of engineering talent here. Shouldn't stop anybody from starting a technology company here.
So why do you think that there's that perception then that there is a lack of talent?
I think that for a long time, because of the lack of the infrastructure that we talked about earlier, there was kind of inferiority complex in here. And it is true that it caused a situation where a lot of the university kids that graduated didn't consider staying here as part of the ecosystem. But the amount of engineers here is remarkable. I mean, at TrueCar, we have, triple-digit number of engineers in Santa Monica, and finding great engineers has never been our challenge, and the same is true for Cornerstone on Demand. That's not, we don't have an engineering problem.
I'm curious, how many people in here, I don't think it's going to be many of you, but how many are you raise your hand. So a little bit more than I thought. Cool. Do you guys feel that there's a really high demand for you and not a lot of you, so you don't have much competition? What are you guys investing in right now? Like, what's sexy?
Well, VR is sexy. I think mobile, we're seeing a lot of innovation around, I'd say, the next generation of Snapchat or whatever. It's sort of mobile meets music, messaging meets music, meets video. So there's a lot of work going on there. Clearly a lot in the video space. Another area which I think we're seeing in LA, there are companies like Industrial Toys that are innovating with kind of core gaming, but high quality, high resolution mobile gaming, and that's actually a lot of that is happening in this community as well. So I think one of the issues, though, it's funny because the guy who ran the investment group, Google invested in our company at one point. His remark was that Northern California companies are formed by engineers whose basic perspective is engineering conceptually, like we're going to make your life more efficient, and that the LA model is more like what we try to do here. A lot of companies down here is really about taking you somewhere else. It's an entertainment experience. So you create, even though Disney is a very great engineering company, the head of Disney is not an engineer, and whereas the head of a lot of companies in Northern California. So it's a kind of a mindset also of functional. And we're really good at wasting your time, meaning in a positive way, right? I mean, in an artistic way or an experiential way. And so I think once broadband hit the internet, all of a sudden LA woke up because they could see that, hey, now emotion and design and character and all these things matter. And I think actually Kara Swisher did a whole article about it with engineers with taste, so to speak. Why? Because they were asking her, why is this happening now in LA? It never happened before. Well, because the way things look and feel and make you feel are starting to matter, right? And where it didn't matter in the narrowband web. So I think clearly there's still amazing companies being innovative up north. Uber is a great example of it. But there's this issue of is beyond just the functional, it is a cool product, makes my life a little bit easier. I think that's a place where LA and maybe New York will start to stand out from that perspective.
What's sexy?
Yeah, I mean, I think, so I'll talk about two things. One, if you take the Fortune 500 and you basically you lay out all the companies and try and bucket them in different sectors, I mean, you just realize that there are so many businesses that have been around for hundreds of, 100 years, 50 years, 60 years, that haven't quite kept up with the pace of technological innovation. So, there's a bunch of interesting startups coming up in some of those sectors. So, I mentioned real estate earlier. I mean, there's a couple very interesting marketplaces for real estate lending and equity here in LA, Asset Avenue, Realty Mogul, and there's a couple up north as well, like Realty Shares. And so allowing actually now accredited investors as well as institutions to invest directly into commercial real estate or residential real estate. There's a startup here called Honk that is basically creating the next generation of AAA, like basically on-demand mobile roadside assistance. So, I mean, why would I want to be a AAA member if I could pull out my phone and say, hey, I need help, I'm stuck in a ditch. I'm in a pothole on Sunset because the city hasn't fixed it. And so, I think that's one side of it. And then the other side is really people are, the millennials are being reached on mobile, on all these different application layers that sit on top of mobile, and that's where the eyeballs are, and that's where people are spending their time. And so I think there's really an opportunity to build next generation consumer brands. So there's a company down in Newport Beach called Acorns that's a mobile first brokerage that invests your loose change and puts it into ETFs, and they're growing like wildfire. And so, there's a company here called Headspace that's down in Venice. It's a mindfulness application. It's a meditation app. And again, same thing, growing like wildfire. And so I think there's also an opportunity given the rise of mobile, to build these new consumer brands. And I think that's kind of what we're excited about.
How many people in here have a startup? Raise your hand if you have a startup. And keep your hand up, and put it really high so you get a little stretch in. Yeah, be proud. Now, of all of you that have a startup, keep your hand up if you've had it over 3 years. All right. Very cool. So everybody in here wants to aim for making their startup last. So one thing I want to ask is, how can people get your attention that are looking to raise?
Well, I'm probably maybe go in earlier than most. So I do seed really early stage, and to me, it's really about ultimately, first of all, it's about a person, like a company, like a people, really matter. And secondly, what are you trying to do? And third, one of the things that happens with entrepreneurs is they tend to be very smart. They have lots of ideas. There's lots of things they could do, but there's this incredible balance that's really required between having this big vision and then being able to understand the 2 or 3 things you need to do to move the needle. So you would go from my investment to Greycroft, or let's say, or March, or somebody else. So for you to move from a seed or pre-seed model to a seed to a Series A, you have to be very crisp about not wasting a lot of time wandering around in the wilderness, so to speak, but understanding these 3 metrics as what I have to move the needle on. And ordinarily in the beginning, it's the early stage people are playing around with what's the product, is there a product idea here, and then eventually does the product, whether it's video, whatever it is, does it get traction, and then of course can you monetize that traction? So that's kind of the stages. But that's one of the things that I recommend really be focused when you talk to investors. Be really clear about, I need this amount of money to go from here to here, and that will then all of a sudden attract somebody else right at the next stage, and that's really critical for me.
Alyse, what do you think?
Right, I agree, and I think this question relates to the last. So what we look for and how to get attention certainly is leadership and execution, ability to execute through fantastic leadership, right? And that becomes very clear, even if you're not an experienced founder that has proven themselves before.
What do you guys think?
I'm also going to tie it to the 2 questions together. So at Amplify, naturally, we see a lot of companies in the earlier stage. And again, trying to make it somewhat maybe actionable for you in terms of what's the market and how you get our attention. So frame the challenge a little bit. So you guys have all heard the term product market fit, right? So when your product reaches a certain level of velocity where it's clear there's a market fit, and then it's ready for an A round. Most of you are not at that stage yet. So what's the stage before that and how it relates to the question? So typically at Amplify or the early investors look for what I call a entrepreneur idea fit. So in many cases, it's about having a good idea, yes, of course. It's about having a great team, yes, of course. The same thing as, you want to be healthy, young, and rich. That's a good idea, right? Okay, fine. The intention, though, is ultimately building a startup is really hard. I've built many of them failed, and I've had a few cases where I got lucky and I succeeded, and I worked hard equally on all of them. So doing a startup is really hard. Getting our attention requires not only the tenacity and knowing that in order to get to me, it's much easier to get to me if you reach somebody that knows me and then I get a reference from somebody. That's the mechanics. But the honest way that when you actually get to one of us is to show up. And showing up in a way that this is who I am. It's not like an idea. This is who I am. This is the idea of team fit. This is like I'm bursting if I'm not going to do this thing. And you don't say it, it just shows. And you do it when you find something that really delights you, and don't do it because you're chasing some the fame, or being a startup entrepreneur is really that you can work at midnight on Saturday and not go to a movie anytime you want. There's free will involved there. It's really hard. So do it because you really want to. So again, entrepreneur idea fit, find something that motivates you, that gets you out of your chair, that you can't wait to do, and then do it, and eventually you'll get to us.
Yeah, and I guess last thing I would add would be just do your homework. Like, we're typically Series A focused, and so get a lot of inbound requests to look at startups that are very early, and we'll definitely, we're excited that they come into us and we'll entertain them, but really we have to focus our time on Series A investments, products that have hit that, businesses that have hit that product market fit, that are starting to show the signs of traction. And so I think that's the other piece of it. Whereas, Amplify and Alan tend to go a bit earlier, and so.
You bring up a great point. It's a great lead into what I was thinking. So when I raised money for my second company, I learned you have to match with an investor that funds the type of money that you're seeking. And I don't think many people know that. So can you explain? Because I think people think, oh, I just want to raise money or I want to get investment. But like you just said, you're in a business to invest in a type of business that has to match that. So if one of you guys are looking for $250,000, Alyse may not be the right fit for you because she only invests in, $1 million+ deals, or, each person on the stage has something that they work with. It's the way their business works.
Well, so I take the benefit of all of them and I go after them and I provide debt. So it's not really an investment, even though it may feel like it when we do venture debt. Usually our loans start at 1 million and go up, but it's really after the Series A. So there's now we can open accounts and we have the network because we know everybody here, and we can help you introduce, and we can provide a checking account and things like that for 9As. But really on the investment side, we have a very, very small direct investment group, and that's for B and C rounds. But we provide debt at your Series A pretty much.
Can you break down what's seed, what's Series A, what's B, what's C? Because some people may not know.
Do you want to start with kind of where you start out?
Yeah, so I think, and I won't speak for Amplify, but we typically, I'll start with actually pre-seed. So a lot of people say, I need to raise $300,000 eventually to get a seed, so they take convertible notes, right? They take these instruments that are debt that convert at a discount into the seed round. So that's typically the very early way, and it's actually pretty good because you can get started. You don't have to wait for a whole round to close. You can say, hey, somebody that will give you $50,000, or somebody else, you can get started that way.
So seed round is about $10,000 to $250,000.
Yeah.
Where's it cap at?
So those are pre-seed. Seed rounds are kind of like what the old Series A used to be. So they're like $2 to $3. You can see them like $2 to $3 million are the seed rounds, and the A's were like the old B's, so they could be $7, $8, $10 million. It's kind of changed a little bit, the dynamics. So the seed players are actually putting in. Most seed deals that I see are in the 1 to 2.5 range, which is, again, when I did my Series A with Mark Turbik, who in fact is now at Greycroft, that was kind of $3 million was a Series A back then, but so it's changed.
And when you guys answer the question, go ahead and say which one you guys represent, if it's seed or Series A.
I do pre-seed and seed.
And so can you explain a breakdown of how you support investors?
Yeah. So, for example, that $3 million, if you raise between 3 to 5, and it's a VC, we can lend 1 to 2.5 million on top of that. And so what that helps is it helps you with dilution. It's much, much, much cheaper money. At that time, if you have some scale and you have AR or inventory, we can help you finance that at an even cheaper rate. And that's kind of what we play. So after you raise 3 to 5, that's when we layer on debt. Now, if you're a bigger company that's been bootstrapped and you have receivables or inventory or something like that, we can do that too. But on the venture debt side, it's after you raise 3 to 5.
And don't forget, when you close that round, call them immediately. Don't wait till you're running out of money to call
It's
them.
better to ask me for money when you have money than when you don't have money.
So you
I see that happen all the time.
All of us.
so you're saying that startups should go for both Silicon Valley Bank and an investor, like yeah.
Totally. We work together with everybody. Yes. Yeah, we work together with the VCs to provide even more capital for you. That'll make, so you don't get as diluted and you keep a larger share of your company.
Alyse?
So March Capital starts generally around Series A and goes through pre-IPO. So check size really varies, and we're structured to do, what works. So, and what works for us means post-engagement metrics, or on the enterprise side, post-development of a robust early pipeline of clients. And I wanted to circle back to one thing about when to reach out to investors, because I have a bit of a different viewpoint here. So we invest. So for instance, right now we're looking at things where the partners have had relationships with folks, for 15 years, or myself having a relationship with someone for 3 years, or longer. And so I think that even though we start at Series A and even want to, hopefully skew a bit later than that, it's really lovely to meet people at the seed or idea stage and form a relationship, so I can see how you're acting upon the goals you set, and people get on a direction, right? So if I meet you for lunch and I hear that your goal is to have 2 new sale hires in the next quarter, and then the next time I see you for lunch you have 3 and you recruited them from really prestigious previous post, then I start to realize that you can execute on your vision. So I think that meeting people earlier is always preferable, and we're always happy to hear from folks before Series A.
So from the people who raise their hands that have an early stage, how many of you are pre-A round? Most of you? Okay. So forgive me, let's take a little tour
please.
here. Okay, so tutorial.
I love it.
Fundraising tutorial. Okay. I'm reminding you I'm part of Amplify, and when I'm going to go at some point, I'm going to say where Amplify fits along that curve. So one of the good exercises that you do as entrepreneurs start with success in mind. So let's start success in mind and go backwards. So some of the folks here that are the A round. So the A round today is the $2 to $5 million round. At that point, you probably have a roughly million pre-money valuation, which means that you really now demonstrated a product market fit. And the folks who come in on the A round basically come in at the point where it's reasonably clear what the use of money is going to be, because you found a way how to generate money as a result of what it is that you do. There are, of course, exceptions for very high, big plays that haven't done that yet. There's a second, third-time entrepreneur. But pattern recognition, 80% of you probably fall in that category. Okay, so to get to that A round, at some point we need to have enough time in the marketplace, probably around 6 months, that demonstrates that we've now hit the inflection point of scale where we need a lot more money in order to execute what is already working. So in order to get there, there's what is called now Series Seed. Series Seed typically happens either a 1, or we're seeing a lot of them now happening in 2 tranches. So you'd get a $500,000 and then 750, or sometimes 1.2 all in one shot. And basically that is what they used to call the A round. And the difference between an A round and a Series Seed, in many cases, Series Seed will still be on a convertible note. In other words, nobody knows exactly what's going to happen, but it is incredibly advantageous, and all of the Amplify companies fall in that category. Series Seed will have at least 1, if not preferably 2, already institutional investors that look at the company that are willing to take you along the path. So by the time you hit the A round, you already have some institutional money along with you. Now, in order to get to that 750 to 1.2 million, at this point you're not really generating income yet, but you have undisputable metrics that tell the story of how your company is performing in the marketplace. It's very hard, unless, again, there are exceptions, but for most of you, there are key performance indicators in terms of traffic, in terms of conversion rates, average order values, take rate, user engagement. Every company is a little bit different, but there are clear numbers. In order to get to that level of be able to call on 50 investors to get 3 to put money in, because that's usually the ratio. We need to have initial traction with a smaller group, and now we're talking about the 50 to 250 to $300,000 raise. That's exactly where Amplify is. So at that point, you've already kind of showed that you have a market, you kind of have a team, your minimal viable product, in other words, it's not just a PowerPoint, you actually have something tangible and you understand the marketplace, and there's that entrepreneur idea fit. There's a reasonable team, there's a product that appears to start to be working, and we see there's a big enough market, is when you go to groups like Amplify or go to angel groups and raise that $250,000, $300,000. Typically, for 80% of you, to get there, there's a friends and family component to it that gets you the $10,000 to $50,000 that allows you to get enough traction and pay a few engineers and beg, steal, or borrow, right, is the American way of saying this. I'm Israeli, I'm allowed the English second language, that allows you to get there. So I went from the back to the front, I'm going to go again. You raise some friends and family, unless you're an engineer and you have a bunch of friends that can do it all on the go. Then you get to a group like Amplify or Angel groups that allow you to get something. Then you get into Series Seed, still on convertible note, 1 or 2 tranches, and then you get to the A round. And I hope that was helpful.
The one thing that I want everybody to hear again is you said you reach out to 50 to get 3, or what was the metric? What's the goal people should have in their head?
So
I even think 50 is small.
The challenge is that most of the time when you hear stories about companies that succeeded, you have a completely altered story of reality. In most of the time, we have so much rejection on entrepreneur that it's not about building a thick skin about accepting rejection. Rejection sucks. Don't let anybody tell you otherwise. But remember what we talked about, that passion before? When you can't stop doing it because that's who you are, then rejection is just part of the course, and you just take it and learn from one thing to another. And the ratio is probably about 10 to 1.
Yeah, and this is actually a really important point, because one of the things I always tell people when they're going to go out for their Series A, let's do a few throwaways, because they typically go in there and they're not crisp enough in their presentation or whatever it is. One of the things is, if you have conviction, you got to be very careful that somebody tries to talk you out of it because they're e-commerce leaning and you're really doing something different, or whatever the case might be. But if your message is not getting clear across, take every one of those meetings, especially the rejections, as, hey, what can I learn from that? What did I not communicate right? What was I not crisp enough of right? The other thing I would suggest is, if you're going to go raise money, try to find out from other people that are doing this, hey, what's that investor's particular pet peeve? There's some investors that'll say, I'm not doing Series A until I see revenue, right? Some investors don't do that, right? It's good to know that, and if you're in a meeting, ask them that question, because you can waste a crazy amount of time, right, with people, which I know they all, a lot of investors want to see you because they don't want to miss the next Snapchat, so they'll say, oh yeah, we'll talk, and we just keep talking and talking. They don't really tell you no, and you wonder, what's going on? I thought I had a great meeting. But part of that is, hey, what would it take for you to invest in me? It's not a bad question to ask, because some of them will be blunt to you. Say, I want to see $100,000 a month in revenue before I write a check. Then at least you know that, as opposed to you're always constantly guessing. But really look at every one of those meetings as a learning opportunity, and it'll help you hone the message. That doesn't mean change it necessarily, but certainly hone it.
I think one thing to also keep in mind is that, well, and it's a little bit different with angels, but investors have their own investors. Like, we have LPs, right, limited partners, who give our partners money to, and that those LPs get that money from somewhere else. Oftentimes, it could ultimately be a pension fund or an endowment or whatever it is, and so they gave us money to invest on behalf of them. And so when we accept that money, it comes with terms and conditions, very much like when you accept investors' money. And we commit to a strategy. We say, we're going to look at this stage, and we're going to look at these sectors, and I'm not going to start investing in Thailand. I'm going to invest in the United States, and whatever it is. And so you have your strategy. And so I think just one thing to keep in mind, as you think about who you're going to target, and as you go through those meetings, just a good reminder.
And before I move on, because it's a perfect tie into my next two questions about traction, about the differences between angels, what do you invest in? Like, what does Greycroft invest in?
Yeah, so primarily focused on Series A. We do both B2B and B2C, so both business to business and business to consumer startups. And I think traction. We look at traction, and to Oded's point, that can mean a bunch of different things depending on the type of business. But if you're a revenue generating business, and don't hold me to this because there's always exceptions, we like to see something in the six figures on a monthly basis. Very, very low six figures, or maybe close to $100,000, but that's what we like to see. And again, always exceptions. If you're a consumer app, we want to see really fast month-on-month growth, and we want to see people using your product on a consistent basis, and we want to see that you've been able to reach a couple 100,000 users. So I mean, those are just helpful benchmarks when you come to, at least I can speak for Greycroft, when you come to Greycroft and you're looking for a $5 million check or a $3 million check, or you're trying to raise a total round of $8 million, those are the kind of things that, just rule of thumb numbers, and always exceptions.
By the way,
I was just going to say what you said is actually very, very important, and this gets back to this crispness, right? In other words, do you have a good product? Are you seeing growth of users in that product? And then are you monetizing that? So a lot of times people will say, well, I'll just throw my product out in the marketplace. It doesn't get any traction. You're dead, right? So you've got to be really crisp about this question of, do I understand what I'm trying to do? At which phase am I trying to do it? When I walk in there and I've got a great product and I've got 1 million installs or whatever the case, and it's still growing, and I started to monetize it, go get the money then, right? Because all businesses have their ups and downs, and you have to figure out a way around it. But this is an issue because people will look at that word traction, and a lot of people just take that lightly, like, oh, I built a really great product. Now how am I going to get an audience? And in fact, we are now in an era where building product is easier than ever. Making a website is easier than ever. Building apps are easier than ever. A lot of apps look at there and say, I'll just copy what Uber does in terms of the UI, et cetera. What's really challenging is getting audiences. I see a lot of companies in the seed space where they'll say, oh, but we kind of stalled here. We're not getting the audience. We don't know how to do it. And then, of course, even in the third challenge is, can you monetize? That's why these monster companies get these crazy valuations like Snapchat, because they're proving the traction. Right, and the leap between traction with audience and traction with monetization is far less than the leap between a product idea and actually having audiences pay attention. So it's really important to be focused on what phase of the business you're in.
And I promise you guys we will have questions period. I always have questions, so don't worry, you will get your questions answered. And the hashtag for tonight is TZ Startup Forecast, if you guys need it. So that's TZ Startup Forecast. So that leads into perfect. Next question is, what's more important, great revenue model and no traction, or great user traction but no revenue model? What do you guys think?
Yeah, I mean, I think you just have to be authentic to the type of business you're building. So up until, 6 months ago, 3 months ago, Snapchat didn't have any revenue. It's a great example that Alan brought up. And but it didn't matter to investors, and it hasn't mattered to investors thus far. Not that it's not important that they're not thinking about their monetization and how they're going to do that, but they just had such incredible breakaway velocity. They were growing so quickly, sitting on top of the App Store and Google Play. And so it depends on the type of business. If you're an e-commerce business, I mean, you have to sell stuff. Like, just because you have a bunch of people coming to your website doesn't mean anything if they bounce off. So it really actually sort of depends on the type of business you're building and what your vision for the business is.
What do you guys think? Traction, no revenue, or revenue, no traction?
For us in the bank, it's really, if you're going to have no revenue, then you have to have really, really, really great investors willing to back you for a long time. We don't see that in LA that often. LA is all about making money, and so we see revenue early in LA than you see in the Bay Area.
That's a good thing, right?
Yeah.
Yeah.
Oh, it's just a.
Why do you say maybe?
Well, I mean, if you look at the great companies that have been formed in the last 10 years, Google, Facebook, Twitter, Snapchat as an example, none of them, in fact, Google didn't even know what its business model was when John Doerr and Moritz invested in them. So I think the issue is, what's really, really hard now in this era with all this clutter and all this stuff that's out there is getting crazy traction. If you get crazy traction, there's clearly a belief that, okay, when we decide to turn the money on Facebook, guess what happened? Boom, right? You'll see it happen with Snapchat. it'll really happen. Now, not all businesses are platforms like that can have that. So most businesses are kind of more of a blend, like, okay, we're getting some traction, let's get some revenue. But I would really, really say for all entrepreneurs, traction is really, really important because it's going to be increasingly harder to get because there's so much stuff out there to choose from, at least in the consumer side.
So I think these things are related, but rather than saying the word traction, I would say engagement, and then also equal to engagement is churn. So are you retaining the folks that are using your platform? How are they interacting with your app or your website? And the reason I say engagement rather than traction is because traction or growth can often be driven or fueled by capital, right? And so really I prefer, so if you have 100 users, but they're using your app for 2.5 hours a day or for whatever, for 30 minutes a day, to me, that's more interesting than if you have, 100,000 users that, log on every other week.
Engagement's a better word.
Right.
You know,
Go ahead.
I want to take a lesson I learned when we started TrueCar. So many of us were actually part of the Cars Direct experience, so we kind of did that before, and we kind of understood what that means. And I think one of the reasons TrueCar had the magic that it did is because we didn't actually, yes, of course we aimed to make a change in the car industry and all that, but there was some fundamental way that our North Star was about delighting consumers in the way that they buy vehicles. And that North Star really informs that discussion around if you get traction here or there, because traction comes from that core of an idea, that same core of the idea that you can't stop doing it because that's who you are. There's something about that core of the idea that is really about delighting people, really making a change in their life in some meaningful way. And typically, when you really stay honest to that, there's some metrics that actually translate into actual numbers that you can show on a slide that go in the right direction because you actually affect people in a positive way. And what are those numbers and how you delight people are usually completely in correlation to one another. So once you understand in a way that how you're making this impactful, meaningful change in people's lives when they interact with you and your product, then the numbers are going to tell the story in the same way.
Yeah, and one of the reasons why the internet is so good at solving a lot of those problems is because a lot of problems are about intense fragmentation. So, markets that are super inefficient, processes that are super inefficient, and then all of a sudden something like eBay shows up or Uber shows up or some other open table shows up which says, oh wait, now because we can use the internet, because we can connect to people in a marketplace or an environment like that, I can actually create a really efficient thing out of something that was painful. And so that's where that issue of, when I first started using Uber, I thought, oh my God, why hasn't this always been around, especially when you're traveling or open table or any of those things? And it becomes this kind of natural, I like that term, it adds joy or makes it easier for your life. But a lot of it is based on the fundamental idea that problem is high fragmentation. You cannot solve it in ordinary media, and the internet is the perfect solution to solve that problem.
One of the things we all know in here, and we've brought up on the panel, is that it's really hard to grow startups. So what are the support systems in Los Angeles that you recommend, mentor programs, that you think people should look into to build a smarter company?
Amplify.
So,
Seriously.
before we started Amplify, part of why I wanted to start Amplify as a co-founder is because
And Amplify is an accelerator.
Amplify is an accelerator.
And what's an accelerator mean?
Let me get to that in
Okay,
a second.
got it.
I never answer short answers. You notice that by now. I'm so sorry. At some point, you get in a point in your career where you want and willing to give back. And the good thing, and what we talked about earlier, there's a lot of people in the LA ecosystem right now that can and actually want to give back. And if you look at the role of the mentor, and not somebody who works for you, that's one thing, not somebody who gives you advice, it's like legal advice, should I do this or that? Well, that's specific advice. I'm talking about mentorship. 90% of what's going to kill your companies if they die, and I hope they're not, but if they do, is mostly the stuff you didn't know about. And the biggest challenge for startups, and the most important thing that you can do to help yourself inside of this ecosystem is to find a mentor. And the mentor has only one function to fill with you, not to give you advice, but to bring to your focused attention all the things you didn't know about. And I'm telling you that I constantly have people come to me, and that's part of the role at Amplify, and I'm going to do a segue, that say, how can I help? How can I help? And the main challenge we have in this community is all of you guys don't reach out and ask for it. Please do.
But where should they reach out? That's the problem. We don't know where to reach out.
So the funny thing is all the mentors that want to help ask me the exact same question. Come to an event like that, ask somebody, and do the bowling alley.
So maybe this is this is the challenge, right? That in Los Angeles we have mentors that want to help, and we have startups that need help, and they don't know where to connect with one another without, raising money first or having the right connections.
And
Well, the role of the accelerator is really a good role because even like angel investors like myself, a lot of them will be, okay, so we've taken the company through the accelerator. Now we want to raise more seed money, but they're not quite ready for a Series A. And so there seems to be a step. A lot of the companies that are coming out of the accelerators have more capital invested by some of the seed players, and then eventually to go to seed. So it's a very important function if you have you're going to start from zero. To go through like an accelerator.
We
It's a
keep
good idea.
using this term accelerator, and I just want to make sure, because not everybody knows what's an accelerator, what's an incubator, what's a venture capitalist, what's an angel, what's the difference between all of those?
You're the accelerator.
Go for it.
So an angel investor is someone who typically is investing their own money and just actively investing in startups, sort of at what Oded described as the angel round. So you're raising a couple $100,000. You're getting the idea off the ground. Maybe you have, the shell or the workings of a product. I should let Oded explain what an accelerator is, but I'll give it a shot. I mean, it's an organization that basically also invests money, oftentimes at terms that are set, but not always. Sometimes in a class structure where they say, okay, now for spring of 2015, we're accepting applications, but not always. And oftentimes there's a physical working component to it as well. So in the case of Amplify, they have a building. It's in Venice. It's beautiful. You should go visit. And their companies work out of the companies that they invest in work out of Amplify. And they also provide a lot of mentorship. A network of people who help out, a sense of community. And so it's very cool, especially if you're kind of you're on that lonely path of being an entrepreneur in the beginning. An incubator is not dissimilar, but oftentimes will have a much greater hand in starting the business, and will have a larger percentage of the company that they take. And then you get to venture capital firms across a variety of stages, and we basically we take minority stakes in exchange for investment, and we're with you for the life of your company. So it really is like you're finding a partner, you're finding another business partner. It's in our interest to help you grow, because we only make money when you either sell or when you IPO. I mean, those are really the only two ways that venture capitalists make money. And I talked about earlier, there being LPs, limited partners, that we answer to as a VC fund. We have to return all the money that they give us. So if we raise a $50 million fund, we have to return basically almost all of that money before anyone at the firm can even make any money in terms of upside. That's not salary. And so that's sort of the spectrum.
Let's share. I mean, Amplify is great. Yes, go ahead.
Do your homework. I mean, if you see a VC or somebody has done it before, like Alan or Oded, and you want to meet them, do your homework. Look at their blog, look at their Twitter feed, look at everything, so that when you actually get the chance to meet that person, there's something that you can connect with. I know LA is big, but it's not that hard. The tech community is not that big, where if you put your mind to meeting somebody, you can find a way. You can come to one of the events, you can get your lawyer, your temp CFO, me, any of the service providers. Like, that's kind of what we do. Like, we can help you introduce to people, but you kind of need to do your homework, because I'm not going to do it for you. You need to tell me, hey, I want to meet so-and-so, and this is why. And this is what I can bring to that person. And then sometimes I can facilitate that. Like, I'm going to ask the person if they want to intro to you. But if you don't do your homework, I don't think anybody's going to do it for you.
One other one aside from Amplify, though, what's one mentor program that you guys know about that people should maybe look into?
We see companies coming out of 500 startups, Y Combinator. There's a bunch of those up, especially up north, and there were more down here, but I think Amplify is the one certainly in this part of the.
So do this. If you guys have any question about finding a mentor and you want to find a mentor and you just really don't know how, or maybe you're shy and you're just uncomfortable with that kind of exchange, that's what WeAreLATech is for. And I'm just saying that because I'm sitting here because I want you guys to succeed. I'm committed to your success, and I won't have it any other way. And every panelist here has a good heart, and they're committed to your success too, because these are really busy people that have a lot of stuff to do, and they're spending their night with you. So if you have any question that doesn't get answered tonight, if you don't know how to reach out to a mentor, just reach out to me, and then I'll facilitate that to make sure you're taken care of. And oh yeah, go ahead.
She's the Terminator. She's right down.
There's one cool mentor program that's new-ish to LA, which is called Pay It Forward Labs, and they're just events where there's mentors there, and then super mentors, which is just meant to be people that invest or have experience as entrepreneurs, and you can go and book time with mentors. And schedule 20-minute sessions. And so it's a nice resource, and there's a couple hundred people there that can be helpful at every event.
And I almost forgot, Tech Zulu has mentor speed dating that we used to do. And so I'm sure, we'll be doing it again. So again, check out Tech Zulu because they'll have the mentor speed dating, and that I've been involved in that. That's been really fun, and these awesome people come out, and what you do is you talk to them each for, I don't know what it was, 10 minutes, and you can ask them anything, and it's amazing. But what I'm going to do is I'm going to take a couple questions, and we'll go back to questions. We'll kind of bounce around a bit to keep it interesting. So raise your hand if you have go ahead.
I'm interested in hearing from some.
And speak really up so everybody can.
I'd be interested in hearing from some of you what you expect from the startup. Just a typical case. In other words, what is the startup giving up, and what are you giving the startup?
You mean financially?
Financially, what does the startup
What are you giving up as a startup?
In other words, if I come to you, what percentage are you taking, or what are you giving me financially, and
What percentage do investors typically take when they give money to a startup?
I'll take that as a quick tutorial. So you remember the discussion we had about success being the A round and looking back? Let's do the same exercise. So rule of thumb, it almost doesn't matter how much money you raise. Your A round investors are going to take about 30% of your company, and they're going to more or less insist that 20% additional is going to be reserved for your option pool. So typically 50% of the common is going to remain with the original founders, and the rest of the 50 is going to go 30-20 again.
You're using a lot of terms, common and option board. You got to tell them. They might not know what that is.
Okay. Fair enough. You want me to go through all of this?
Go for it. I mean, that's what we're here for.
Okay.
We're here to learn.
So similar to what was said earlier, the 30% investors, typically their particular prefer would fall in a different class of stock that your original common stock. They're called preferred stock. And generally the difference between preferred and common is the money goes out to the preferred first before it goes into common. And there are a little bit of mechanics there because sometimes there's special preferences, sometimes there's multiple preferences, so sometimes it's not one-to-one. If I put $3 million, I get $3 million, everybody else gets the rest. Sometimes I get as much as 60. But in general, preferred stock works differently than common stock. The 20% option pool is an option pool that actually gets distributed between all of the entities, but it dilutes the original founders, and that option pool is now used in order to attract new talent as they come into the company. Okay, that means that 50% or so of the company, pretty much, if you owned 100% of the company, after the A round, you own 50, basically. Now, before we get into the A round, if you remember in our little tour that we did earlier, there's the convertible note rounds. And Amplify, the angel investors, the seed round will all fall in convertible note. Now it gets a little tricky. So typically a convertible note will say, let's make it simple numbers. So let's say that I'm giving a convertible note with a cap of $2 million. What does that mean? This is important because most of you are going to do notes with caps. So hopefully, I hope this is helpful.
Yeah, wait, let's find out. Raise your hand if you're finding this helpful. So I think it's helpful.
Okay, thank you. So basically what CAP says is this. Let's say that you come to me and I just fall in love with your idea and I'm willing to give you $5 million, but the whole idea of a convertible note is nor you nor I can agree on what the valuation of company is going to be. So we agree that in some later stage, my money is going to convert to the same kind of investment terms that your A round is going to get. Now, the challenge I have is this. I'm putting the money now. The investor is going to put the money a year and a half from now, and by that time, my risk level is dramatically different. I should be rewarded for that risk. So how do you calculate that? So the industry, little by little, came up with a set of terms that kind of solved that problem. And kind of solved that problem mean that if by the time you do your A round, a $10 million round, whatever I put money in has a cap of $2 million. In other words, I don't care how big the round is. If it's bigger than $2 million, then my money comes in a $2 million valuation. So it's the same, okay, with me? So it's the same as we saying the company is worth $2 million now, but if it's not, then we both win. If it's more, then I get the benefit. That way, when I put the money now, I know that if the company is wildly successful, I don't get screwed for putting the money first. Okay, that's basically the idea. Now, because of the convertible notes, by the time we get to the A round, now it gets complicated because potentially, if we follow the math, the angels got at the $1 million cap, Amplify came in at $1.5 million cap, then we did a series seed. First one, we did $500,000 at the $5 million cap, then we did an $1 million cap, and then we got the $12 million A round. Go do the math. So generally, there's a little bit of spreadsheeting that going on. So it says each one of the investors along the way, how much they get, but generally, all of the investors will get their respective percentage as a preferred share like the investors coming in. So ultimately, when you look at your A round, it's not only the A round that's coming in, is the amortized value after the cap is calculated for all of the investors that came along. But by the time the A round is done, you'll probably have common own 50% and everybody else owns 30 and an option pool of 20, rule of thumb.
Did that help you? Okay, great. And I know you had a question earlier, and then we're going to go back into questions up here, and I promise I'll get back to questions for you again.
By the way,
Yeah.
Fred Wilson and his New York VC has a really good blog about this. He has a lot of comments about this, but his perspective is you should try to go no more than 20% dilution on every phase. That doesn't mean you can get there. If you're young and if you don't have a lot of experience, and you're raising too much money, might not get there. But that's at least from the entrepreneur's perspective, is a rule of thumb of what they attempt to have happen. Whether you can get there or not is a different thing.
What was your question earlier?
Basically, what it was is a good idea. It's an excellent idea. Without the driving force, which you guys asked about attraction, right? You guys said about attraction. I call it driving force. It's the force that really gets you.
What's the question?
My question was any example that you might have that it was a very good idea, but it was not really attraction. It was not really driving force.
Example of a great idea without traction.
Well, no, in fact, you probably could look at a lot of very successful companies now where that idea had shown up before. And part of it could be it didn't get the right engagement. Part of it could be the internet wasn't quite ready for that. And part of it could have been, it's not just necessarily whether you got it right. I mean, sometimes it's timing, right? I mean, a lot of all this video and VR stuff is because the web is broadband now. And no one in the entertainment industry was interested when it was not, right? So it's not just that issue. So you get these perfect storms, right? When there's a lot of mobile phones and you can do Uber and that works, but that's because there's a lot of mobile phones. So there's a lot of times where you've seen, hey, that idea was around in Internet 1.0, didn't work, but it's now working, right? So it's not necessary. It's also timing, I think, is a big question.
Did that answer your question? Yes. Great. Go ahead.
No, I was just going to chip in. I mean, Instagram's a good example. They weren't Instagram to begin, right? I mean, so there's definitely businesses that sort of, it's a overused word, but pivot into either different businesses or they rebrand or what have you. And the other thing I would say is that not everything necessarily has to be a venture-backed business. You don't have to necessarily always raise. I mean, you can raise a little bit of money, maybe friends and families, but from friends and family, from angels, but not everything necessarily needs to have a venture capitalist or a seed fund involved, and it is to some extent expensive money, as Professor Oded pointed out. So I'm going to start calling you that now. So that's the other
That's
thing.
for sure. You can fool some of the people some of the time.
Vice was a good example. That's a company that's been around for 20 years. It was a print magazine. They went bankrupt. They pulled it out of bankruptcy. And when video came along, they found their sweet spot. And now they're $2.5 billion company. So
Vice is epic. I love Vice. LA. What makes you excited to be an investor in LA?
Well, I think I've said it already. I think LA is, it's the mixture of entertainment and e-commerce models and messaging. I think the creative community and the combination of technology and creativity, I think, is creating a new type of company. And it's not just like, oh, we're just regular content guys and we just make content. Most of these companies either understand the role of data, they understand the role of platforms. They're operating half like an internet company, half like a traditional, let's say, media company. But that's one of the reasons why it's a unique opportunity, because it's not necessarily in the mindset of Silicon Valley to create a lot of media-oriented companies, and I think it's a big opportunity for LA and New York even, but LA for sure.
And my part B to that same question is, do you think we'll ever get close to Silicon Valley? So why are you excited about LA? And then do you think we have a chance, even in the next 5 years, how long do you think that will take? Go ahead.
Really excited, and I'm going to steal a lot from Mark Schuster, if you guys don't know him. Read his blog on the other side of the table or whatever, two sides of the table. He's really probably the biggest advocate of LA. And I think there's more companies formed in LA than anywhere else. So just because there's more, there has to be some good ones. And I also think that now that there's exits, there's TrueCar, there's Console on Demand, there's a lot of exits here that they're staying, there's IPOs. There's just a great opportunity. And I think LA is about making money, and Silicon Valley was about kind of building the rails for us to make money, for you guys to make money. And so I'm really excited that I think now with broadband and everything, it's time to make money through the internet, and that's what LA is about.
Great. Alyse?
So I think that it's always exciting. So I always root for the underdog, and I think it's exciting to see the unexpected emerge as a leader. So that's one of the reasons why I enjoy being in LA. And also entrepreneurs here, it seems, have a better, have made an investment in the quality of life that they have. Maybe if it's only even in the 20 minutes, from walk from house to work, it's still a beautiful 20-minute walk. And so it's nice to be in LA. I think that one thing that has to happen for any city to emerge as a leader, as a hub in this ecosystem, is to be very risk-taking. The culture has to support risk-taking. And so as LA opts to do that, certainly we could become an important hub, and that could happen in hardware. There's a lot of reasons why we should be leader in hardware. That could happen in distributed network technology that's emerging now and is open for any city to pop up and lead. And so I'm very hopeful that happens.
Go ahead.
I'm going to say something that sounds a little strange, now I'm going to explain it. So I'm excited about what's going to happen in LA because I live here. Now,
Drop the mic.
this is not because when I say I don't mean Oded. I mean I as every single one of you. I'm excited to live here because the way you started this discussion is to say you're excited about this community. And that idea is infectious. And we're here because we're willing to support each other. That doesn't happen everywhere. That happens where we live. And it starts in a company that I built because I'm passionate about. And as long as I show up, and when again, I'm not talking about Oded, I'm talking about I. When I show up and I do what's exciting for me, and I'm surrounded by people who are willing to give part of their time to buy people lunch and to do all the things we're talking about, then we create a community that we want to live in. And that's infectious. And then more great things will happen here. That's why I'm excited.
Tough act to follow. I'll be more literal, I guess. I mean, obviously, there's a lot of very exciting companies here. many of which we've already mentioned. I also think the city's becoming more connected. I think there's almost, I mean, zoom out from tech, on a more meta level, I mean, I think this is really, there's a renaissance taking place in LA in some sense. The metro line's going to connect downtown to Santa Monica. Playa's really being built up. Microsoft's going in. Google's going in. Facebook's already there. Yahoo's going in. Culver City's become this crazy cool hub of the YouTube ecosystem. YouTube's now the second largest search engine on the web, and basically everything having to do with YouTube, around the creators and a lot of the business around it is here in Culver City. The mayor's office is making a huge push to really, grow things out in downtown. We just moved our offices to the Arts District, which raised a lot of eyebrows. It's cool, yeah. I know we're in Santa Monica. We used to actually be in Santa Monica on Ocean, and we've literally gone as far east as you can go. And I don't know if you guys have ever spent time in the Arts District. It's an incredibly exciting place to go right now. I mean, there's a lot of very cool things happening. So I just think the city's becoming more interconnected. There's really just a lot of development taking place. The food scene's booming. So I think it's just a great time to be here.
I mean, that ties into my next question is your 2015 forecast. Why don't you continue in what you were saying? You were talking about a lot of, like, Google coming into Marina Del Rey, things like that. Keep going. Playa del Rey. Thank you. Continue. Yes.
Yeah, I mean, look,
Specifically for 2015.
Specifically for 2015, I think it'll be really, it'll sort of be come to Jesus, if I can use that term, of a lot of the consumer businesses here. Snapchat's starting to monetize. I don't know if there's any Snapchat users here. Chances are there's several, but they launched a feature called Discover, and it's now this like homepage essentially for all these different brands, and they're really showing how they can be a media property and some media platform in some sense. Tinder's started playing around with monetization. There's a bunch of e-commerce companies here that are really being primed for IPO, like Honest Company and Just Fab and what have you. So I think it'll be a really telling year for pushing things to the next level. We have a lot of talent, a lot of potential energy, and I'd love to see it continue to go.
Awesome. 2015 forecast.
Amplify has something like 42 companies, forgive me if I get the number wrong, but at any point in time, at this point, 15 of them or 18 of them are raising capital. And what we're seeing is, by great numbers, most of the capital we're raising right now, and we're averaging about $750,000 of seed investment within 3 months of joining the program is about our average. Most of that capital is not LA-based. So we're seeing more and more institutional investors that look at LA as this new center of innovation that's starting to evolve. And the other thing that's interesting is I think 50% of our application almost are not LA based also. So most of the companies we're seeing right now actually want to come to LA to do that. So when you join these two things, it's an inflection point and it's exciting.
Awesome. Alyse?
Are we doing LA or tech in general?
No, LA 2015 forecast.
That's more difficult. Okay, so I think, as I said, I think LA and hardware makes a lot of sense, and I think that connected home and data-driven, so software with a focus on data-driven hardware is going to become increasingly important, and so LA potentially leads here. And so I think that we see leaders emerge in the hardware space that can potentially develop and grow an ecosystem in which hardware companies are attracted to LA. So I'll go way out on a limb. I'm sure nobody else thinks that. But I see this happening in LA and in fingers crossed for its continued growth.
I think that there's a lot of kind of medium-sized startups now here in LA. I think there's a new crop, Honest, Dollar Shave, companies like that. They're really going to become, nationwide, huge names, and we're going to see a lot of benefit from that. I'm a little concerned that we all see only good things right now. So that's when, as a banker, I get concerned. But that's just because I'm a banker. I hope that somebody can help us with real estate. It's just such a pain to buy and sell real estate and stuff. So hopefully one of you guys are solving one of those problems.
We have a company doing that, so we can talk.
There you go. Because to me, it's just, a delightful experience with real estate, I would love that. So if anybody's working on that, hurry up.
It's Agent Ace, right?
Yeah, I think
Agent Ace solved that.
exactly.
So
They were part of the Tech Zulu Tech Crawl.
That's right.
Go ahead, Alan.
Yeah, I was going to say, I agree that there's a lot of companies that should be, a good number of companies that should be either hitting an IPO or being acquired. I think in the space that I'm focused at, which is video and VR, video is a really interesting category because the number of buyers that are entering the market. So at the very top, you have Apple, Facebook, Google, Twitter, all those guys. None of them are going to see the video space. Somebody at Apple said to me, well, we might actually, we don't care whether someone tweets some text around. We are never going to see video. We saw what happened with Twitch. We see what Amazon's doing, start launching movies, all of that. So video from those guys. Then you have a whole crop of companies that are very powerful television networks in their own countries, and they're going to start buying up a lot of these. A company I was on the board of called Style Hall was bought by Bertelsmann. SoftBank bought Drama Fever. So there's a lot of ProSiebens and the Collective. There's a lot of these kind of players going on. Then you've got the wireless players, AT&T, $500 million deal with Chernin is here in Santa Monica, and companies like Singtel and all of these wireless, because they're seeing the big growth in short-form video that's on the wireless devices. So, and then of course you've got the traditional companies that are the powerhouses here in Los Angeles already, the Disneys and the Warner Brothers, et cetera. So you've got a lot of real tension around video and VR. That's why you're seeing craziness already happening. A $2 billion Series A valuation for Magic Leap, $2 billion exit for Oculus. We're just seeing the beginnings of this stuff, but this is a category that no one is going to give up on, and they're going to fight to the death to actually win that. And I think companies that are in that space are going to benefit, if they have ability to get any kind of traction at all.
Great. And again, we're here for you. So we're going to do a few questions, and then if there's time, we'll do more formal questions again. But let's do questions first. Go ahead.
Yeah, Emily, you talked about engagement and traction.
Engagement's a better word. She's right.
So he wants to hear about the evolution of Machinima.
Well, yeah, I think all the companies that were on YouTube, that what happened with YouTube was, and most of those companies, is that two things happened at once. One was that YouTube grew like crazy. There are over 1 billion people that use that platform. So we have never seen a video platform at that scale before. We all think of Comcast as a big business. 23 million subs, YouTube 1.1 billion people. And then of course the mobile phone came around, which was also a video-enabled device. So in terms of being able to generate giant audiences and brands, that happened way faster than people expected. Monetization happened slower, right? Not slower than people expected, but just it lagged a bit, only because in some ways the growth was so high. But now you're seeing the growth of native advertising, and so you're seeing companies that are really turning profitable. Vice is profitable, Awesomeness is profitable. There's a number of these companies that are already profitable and growing. And then there are these subscription models, Crunchyroll, Drama Fever, these kind of vertical subscription models. Obviously, new companies like Vessel are launching. So there's a lot of activity around this OTT, the over-the-top subscription models as well.
Did that answer your question? Great. Joe. So crowdfunding as a viable option for a startup. Who would like to speak to that? Yeah.
What kind of startup? Is it something like crowdfunding like Kickstarter? Or is it for equity kind of thing? So on Kickstarter, what I've seen is they can have success building kind of prototypes and stuff, but then they really need the funding to go and order, something to mass produce. So I think it's great to kind of get that first engagement and things like that, but you're still going to follow on. If you're going to do products, you're still going to need a lot of money from them here to scale that. I don't know. Does it get?
But I think it's part of the equation, right? Crowdfunding, angel list. There's a number of these activities that are going on that allow you more access to capital faster, and have really blown open the doors of the traditional people that you had to go to get capital. So if you're especially in your category where you're building a product, or you're like a company called Rooster Teeth that was recently acquired by Fullscreen, they raised $1.5 million for a movie they wanted to make, or content they wanted to make. That stuff is very high risk. If you can actually do that, through kind of crowdfunding, it's definitely something to do, something to think about.
Did that answer your question?
Does it get messy sometimes?
Go
So
ahead.
I was going to say, I think crowdfunding becomes increasingly important for startups as time goes on, and we're so early there right now. If you're specifically interested in the space, I would say to look at Swarm, which is a new style of crowdfunding platform built on blockchain technologies, so that really, I mean, I don't think you need traditional capital. I think that soon you'll be able to get it done with crowdfunding, and there'll be reasons to opt for that even when VC firms are willing to fund.
No, I got to take more questions. Yeah, go ahead.
What is, out of content, services, and product, what is what is succeeding in LA most from your perspective?
From content, services, and product, what is succeeding in LA the most? All of them.
Yeah, well, it's kind of a blend. I would say content meets technology. You know, it's kind of the new order, if you will. I think there's definitely around that. But also, LA, look, even the Honest Company, there is this model of, can we use celebrities? Can we use influencers? I mean, we probably have more key influencers in LA than any place in the world, whether they're traditional ones like, say, you know, the music artists and that have huge social platforms, or a lot of the key, you know, YouTube Viners, a lot of them move here, right, because of the path there. So this kind of influence economy where, you know, like Brian Lee does this great job of putting companies together, celebrity, boom, you know, that's a model that we're starting to see here, but certainly, you know, content companies as well. I mean, it's interesting, the irony is that Netflix is a great platform that's done really well, but at the end of the day, people want to see House of Cards and people want to watch Game of Thrones. And this is very important. This is why this is a highly contested space. It's not just about the functionality. It's about the content, and it's about the combined experience of making it convenient, I think.
You good? Does that answer your question? Great. What's your question? What's the environment for social purpose corporations?
So most of the people on this panel are professional investors that have investors that they need to return the capital on. So if you're looking for a social purpose that has a financial instrument that goes along with it, example of a company in town is Causecast, right? So there are companies who do that. If you're looking for a do well but do good in a slightly different format, that we're the wrong audience. But there are a lot of companies in town, like up and coming is a company called Omaze that is kind of in that space where they do well and do good. So it's always possible. But again, you need to know your investor, because your investor has their own investors that need to respond.
Well, I'd say there's a class of investors, and I would say probably a lot of the people on this panel and even in the companies that would look at the idea of, can you create a great company that actually does good things, right? And I think that is a sweet. I talk about this a lot with investors, which would be great to, you know, are there opportunities out there where you can change the world or you can change something for the better in a way that's not just like sort of giving it away, but having enough of an infrastructure change that it's a company that can be profitable and be you know, and do something, some social good. That is a sweet spot where you'll find a lot of traditional venture type investors interested in that model.
Did that answer your question? Great.
Let's go into retention as far as engineers, developers, and Oded, right? Sorry about that. You mentioned TrueCar and Alyse, and then Vishal, you mentioned Asset Avenue, Ace, Acorns, and Bug. So you place a lot of these engineers with these companies. So you can hire your engineer and you can throw as much money into them and say, hey, we're going to give you this much money, equity, stock options. But how do you keep them here? How do you keep the talent engaged into these companies so they don't eventually, like you were saying, not graduate and go up to the Silicon Beach? How do you keep them inside California?
So Oded, you had 200 engineers, TrueCar. How'd you keep them here? You fed them.
Well, yeah, it's called pizza.
Showed them the beach.
By far the best strategy to keep somebody hired for you is when they believe, and they're right in believing, that them staying with you is the best thing that they can do for their career. And that usually requires really paying attention to what's good with their career and then act accordingly. So it requires leadership, basically. In the macro level, I think what's happening and why this wave of startups is not going to go away. In other words, this is not, yes, there's a tech boom to some degree, but besides the tech boom, there's an underlying current that, in my mind, is kind of indisputable, which is, it used to be that you used to go to work for the man, right, the big company, and you got the paycheck, and you knew what it was, and you had job security, and that was part of why you went to work there. That really doesn't exist today. So would you rather work for 20% more salary for the guy that you hate working with, or this exciting new startup that you can't wake up to work in the morning? And where we're making innovation is exactly there. And as long as you create an environment that you can't wait up to get in the morning and you're doing something special, then you get to retain talent.
Awesome. And so,
And it is harder to raise money here than in Silicon Valley. So, like, not only is it, you know, if you're here in LA and you're a Mexican woman, I guess, that's like the trifecta. It's going to be super hard. But, you know, it's all about the passion. And people can see the passion. A young woman, what's the company, Laurel and Wolf? She walked into our office, she opened accounts, and now she's funded. Now she's got a name. And, you know, but you could tell that she was determined. She had a passion. She knew what she was going to fix. And she can articulate all those things very well. And, you know, she's on her way.
By the way, in terms of, like, you know, where it's harder to get funded, one of the things that's, I think, really positive about LA now, I mean, some of the people on the panelists may not love this, but for seed investors and early stage investors, we're seeing where does the follow-on capital come on? And this was one of the big problems here for a long time. And now we're actually seeing more and more Sand Hill Road type of companies. The Andreessen Horowitz are investing here, the Benchmarks and the Red Points and all of those companies. And that's actually, for the community, important because we need follow-on capital. We need risk takers. I think you made a really great point here. The one issue with LA for a long time is the entertainment industry has set up a pay me now. What's this equity stuff? I don't care. Northern California is a lot more about the equity value. This is actually an issue. It's changing, right? Because a lot of music artists are saying, I don't make any money on revenue from Spotify, but those guys made $1 billion when they sold beats, because the equity value in internet companies tends to outpace the revenue you can actually make from it. So the culture here has historically been more, write me a big check for me to do something. I don't believe in the equity value of what's going on. That's a different culture in Northern California, but it is changing from that perspective. I think the second part I think that connects to this is that Northern California, you ask whether we could ever beat Silicon Valley, they have huge companies like Apple, Facebook, Twitter with thousands of employees, all of which start to make a lot of money, and they can go start other companies. This kind of companies at scale in LA is the next big thing. There's a lot of interesting companies that get to 100 people, 200 people, but are there the 15,000 person companies? Are there enough of them? Is there enough turnover for that? As we start to do that, like Snapchat could be a great example of that, that is really going to create a lot of more entrepreneur opportunities. So we need that to happen here.
So one last question.
Yeah, sure. So I would have dropped it if I didn't think it was timely to LA, but I tend to write it down too. So you're seeing a lot of success with next generation publishing and content production.
Can you stand up to everybody?
Sorry. So you're seeing a lot of success right here in LA with next generation publishing and content production acquisition type companies like Vox. I mean, this is obviously not just LA, but Vox, Vice, BuzzFeed, Medium, brands like GoPro. Even this morning, Mashable, Business Insider.
A lot of success with media companies.
There you go. Sorry, I'll get to the question. Basically, what are you seeing in that area where there's obviously video content? Everyone seems to be a content producer now. And it's basically just in general, can you speak to that?
Everybody wants to be a content producer.
I think Snapchat has their own content production. One Nation has one now.
So do you think every startup is now becoming a content production company?
Well, I mean, I think we're seeing the platforms are more focused than ever. Facebook, Twitter, you know, obviously Snapchat's introduced video. Facebook's taking video very seriously. You know, if you think about it from the television perspective, one of the things that added a lot of value were the networks, right? There's a difference between being a content creator, a studio even, and a network, right? Which is really in the audience business and the brand business. I personally believe that those models, in fact, are way more valuable in the entertainment business. ESPN is incredibly valuable to Disney, more so than its studio in some ways. So I think that those kind of brands like the Vices and those kinds of things will end up having more value because they're programming brands. They stand for something. They have an audience. They resonate. It's you know, just being a pure content creator as an individual is more challenging. Now there can be a lot of influencers, but that doesn't necessarily scale beyond the influencer. So I think that's still kind of the same thing, where we can think about it, the first wave of broadcast networks, and then the second wave were the cable networks, and now we have Netflix and Hulu, Vice, and all those. And I think that's where a lot of the value will go to, consumer platform.
Did that answer your question? Yeah. Great.
Also, I think we, as consumers, have never had more power to create, to distribute, and to consume content. I mean, that could literally be a Yelp review, right? I can now go to Yelp and I can sort of hold that over, not that I should, but hold that over a restaurant owner if I don't get, the experience I expect. It's, to the point around female entrepreneurs or just entrepreneurs in general, great example of self-made female entrepreneurs, Michelle Pham. I mean, she's crushing it, and now she has a company on top of that, Ipsy, right? And so it's the power is really being given to us, and it's in part as a result of these platforms, and it's up to all of us to do something about it.
And if you have a question that didn't get answered, I'm not kidding. I'm absolutely committed to your success. Just email me, Espree@WeAreLATech.com, and I'll make sure to get an answer for you. I promise you. I really want you to get everything that you came here for.
One thing to add to that, most of us want to give our time more than we typically are able to. So usually find somebody who has as much time as you need, because they do exist out there. And it's not because people don't want to help, you just need to find them.
And I'm at Espree Devora on Twitter. I want to thank Dethrone Base Camp and Emporium Thai for being here. Remember this Saturday, I hope you'll be working out with me with Dethrone. And mostly, I want to thank Tech Zulu. I've been with Tech Zulu for several years now, and I'm really proud. It's run by Efren, and he is the most inspiring entrepreneur, and I'm so grateful to be his teammate and happy to have the opportunity to share my night with you. So thank you for being here. Efren's going to say thanks.
Thank you. Thank you. Thank you, everybody, for coming tonight.